Let's get to know more about gains or profits from employee stock option and employee share ownership plans. Generally, employee stock option is an option granted to an employee to exercise the right to acquire shares in the company at a future date and at a price which is determined at the date of grant of the option. A stock option or share granted by an employer to an employee by reason of any office or employment constitutes benefits for employment and is hence taxable. The taxable value of ESOP is the difference between the open market value as at the date of exercise or date when selling restriction is lifted and the price paid by the employee. Gains from ESOP are taxable in the year when the rights are exercised. For plans granted on or after 1st January 2003, where there is a moratorium, it is taxable only when the selling restriction is lifted. Employee share ownership is where an employee is granted shares by the company at no cost or is allowed to acquire shares in the company. The taxable value of ESOW is the difference between the open market value of the shares as at the date of grant or its vesting date, or date when the selling restriction is lifted, and the price paid or payable by the employee. If there is no vesting imposed, the gains from ESOW are taxable in the year when the shares are granted. If there is vesting imposed, gains from ESOW are taxable in the year the shares are vested. For plans granted on or after 1st January 2003, if there is moratorium, gains from ESOW are taxable in the year the selling restriction is lifted. The tax treatment of ESOP or ESOW depends on two factors. Firstly, the date of grant, and secondly, whether the employee was exercising employment in Singapore at the date of grant. Whether ESOP or ESOW plan was granted to employee while exercising employment in Singapore before 1st January 2003, the gains would be taxable if the employee was physically present or exercising employment in Singapore at the time of exercise of rights or vesting of the shares. Where the ESOP or ESOW plan was granted to employee while exercising employment in Singapore on or after 1st January 2003, the gains would be taxable regardless of where the employee is located at the point of exercise of rights or vesting of the shares. However, when there are selling restrictions on the ESOP or ESOW, the gains would only be taxable upon the lifting of any such restrictions. Whether ESOP or ESOW plan was granted to employee while exercising employment overseas, excluding temporary absences from Singapore, the gains are not taxable if ESOP is exercised or ESOW is vested on or after 1st January 2002. Employees can be allowed partial tax exemption on the gains from ESOP or ESOW granted under any plans which qualify for the Equity Remuneration Incentive Scheme or ERIS, such as ERIS for SME, ERIS for all corporations, ERIS for startups. For more information on the qualifying conditions for each exemption scheme, you can refer to IRAS website for the latest e-tax guide on Equity Remuneration Incentive Scheme. To check eligibility to the schemes, refer to the ERIS calculator under the quick links on the IRAS website as shown. Appendix 8B is for the reporting of gains from ESOPs or ESOWs. Section A is for the reporting of gains from ESOPs or ESOWs which do not qualify for any exemptions. Sections B, C, and D are for the reporting of gains from ESOPs or ESOWs which qualify for exemption under the respective Equity Remuneration Incentive Scheme. You must convert the value of all shares and stock option denominated in foreign currency into Singapore currency where applicable. For more information on the sources of exchange rate, refer to explanatory notes on Appendix 8B as shown. Let's get to know more about benefits in kind accommodation. Accommodation provided to your employee is a taxable benefit in the hands of the employee. From year of assessment 2015, where the tenancy agreement is signed between employer and landlord, the total taxable value of the place of residence is based on annual value of the premise, and value of the furniture and fittings less rent paid by employee. The value of furniture and fittings to be reported depends on whether the premise is partially or fully furnished. A premise is considered partially furnished if only fittings, example lightings, air conditioner, are provided in the place of residence. For partially furnished premise, 40% of the annual value is taxable as value of the furniture and fittings. A premise is considered fully furnished where both fittings and furniture or household appliances are provided. For fully furnished premise, 50% of the annual value is taxable as value of the furniture and fittings. Only when the annual value of the premise provided is not available, the taxable value is based on the actual rent paid by the employer, including rent paid for furniture and fittings less rent paid by employee. Let us study an example where the company rented a property with an annual value of $40,000 for an employee in the year 2014. The property is fully furnished with furniture and some household appliances. The company has to fill in the details in Section 1. In addition, the company has to fill in the annual value of $40,000 under Item 2A. Indicate $20,000 being 50% of annual value as the premise is fully furnished. Assuming there is no rent paid by employee, the total taxable value of place of residence to be reported is $60,000. In the next example, the company rented a property paying rental of $5,000 per month for an employee in the year 2014. The employee paid $1,000 per month for the rental through deduction from his salary. The property is fully furnished with furniture and some household appliances. The company has to fill in the details in Section 1. As the annual value of the premise is not available, the company had to fill in the total rent paid to the landlord of $60,000 under Item 2C and 2D. Total rent paid by employee of $12,000 under Item 2E. The total taxable value of place of residence to be reported is $48,000. Let's get to know more about benefits in kind, insurance premium. For group medical insurance policy, which is available to all staff, the insurance premium paid by the employer is not taxable in the hands of the employee under the administrative concession. For other group insurance policies, such as group term life insurance policy, the insurance premium is not taxable if the employees are not entitled to the payout contractually. On the other hand, the insurance premium is taxable and has to be reported if the employees are entitled to the payout contractually. With effect from year of assessment 2013, an administrative concession is granted to exempt from tax the insurance premiums in the hands of the employees if the employer elects not to claim for a tax deduction on the premiums in their corporate tax filing. Let us now understand the concept of employees' entitlement to the payout from the policy. An employee is not entitled to the payout contractually when the employer has a choice to decide whether he wants to disperse the payout in the event of a claim. On the other hand, the employee is considered to be entitled to the payout contractually when the employee is the named beneficiary of the group insurance policy, or the employer is under contractual obligation to disperse the payout in the event of a claim. Employer's obligation in this regard may be provided in the employment contract, staff handbook, or collective agreement. Let us look at an example on reporting the insurance premium. Here, the company buys group life insurance and accident insurance policies for all employees. The yearly insurance premium for each employee is $100 for life insurance and $150 for accident insurance. It is stated in the staff handbook that in the event of death or accident, employees will receive the payout from the insurance company. As the employees are entitled to the payout contractually, the premiums are taxable in the hands of the employees and must be reported in the Appendix 8A. The company has to report the amount of premium of $100 in Item 4C under life insurance premiums paid by the employer. In addition, the company has to report the amount of premium of $150 in Item 4K under other non-monetary benefit. Let's get to know more about benefits in kind awards. Generally, awards given in respect of your employee's employment are taxable, unless they are specifically covered under the administrative concession. For awards given to recognize employees' work performance, for example meeting goals or targets, the full amount of awards are taxable. Likewise, long service and retirement awards given in the form of cash or vouchers are fully taxable, whereas a non-cash long service and retirement awards will not be taxable if the value of the benefit does not exceed $200. If the value of the benefit exceeds $200, the full value is taxable. Similarly, for awards given to recognize employees' good service, zero or low medical leave, and passing of internal or external examination, it is not taxable if the value of the benefit does not exceed $200. If the value of the benefit exceeds $200, the full value is taxable. For awards given to recognize employees' efforts in innovation and improvements for company, the full amount of awards is not taxable. In this example, the company gave an employee a plaque worth $200 for his zero medical leave, a watch worth $1,000 for his long service with the company, and travel voucher of $100 for meeting work targets. Are these items taxable in the hands of the employee? The plaque is not taxable since the value does not exceed the threshold of $200 and need not be reported. The watch is taxable as the value exceeds $200 and the full amount of $1,000 has to be reported in Item 4F under Non-Monetary Award for Long Service in Appendix 8A. The travel voucher is also taxable as it is given in recognition for work performance. The company has to report the amount of $100 in Item 4K under Other Non-Monetary Benefit.